Let us begin by understanding the different types of accounts. The accounts can be classified as personal accounts and impersonal accounts. Impersonal accounts can be further subdivided into real accounts and nominal accounts. Let us understand each of these in detail. Personal account, as the name suggests, are elements or accounts which represent people and organizations. For example, personal accounts includes customer debtor accounts, supplier creditor accounts and other accounts including individual account and company account. The golden rule of accounting for personal account is debit the receiver and credit the giver. Let's consider an example. Mr. X has paid rupees 50 to XYZ company by check. The bank account is credited and XYZ account is debited. The journal entry in this case would be XYZ Private Limited Company account debit rupees 50 to bank account rupees 50. Next, moving to real accounts. Real accounts include the elements or accounts which are tangible in nature. Real account includes assets owned like factories, furniture, buildings and other tangible assets like computers. The golden rule of accounting for real account is debit what comes in and credit what goes out. Real accounts have a debit balance by default. Let us consider an example. Company purchased a machinery worth 1000 rupees for cash. Thus, when you debit what comes in, you are adding to the existing account balance. This is exactly what needs to be done. Similarly, when you are credit what goes out, you are reducing the account balance when a tangible asset goes out of the organization. The journal entry in this case will be machinery account debit rupees 1000 to cash account rupees 1000. Nominal accounts represent expenses, losses, incomes and gains. For example, a nominal account includes salary payment accounts, bank charges accounts, electricity expense account, interest on loans paid, interest on investments received, sales account, rental account. The golden rule of accounting for nominal account is debit all expenses and losses and credit all incomes and gains. The rule is applied when the account is in question is a nominal account. The capital of the company is a liability. Therefore, it has a default credit balance. When you credit all incomes and gains, you increase the capital, and by debiting expense and losses, you decrease the capital. This is exactly what needs to be done for the system to stay in balance. Let us consider an example. Mr. X purchased goods worth rupees 500 for cash. The journal entry in this case will be purchase account debit rupees 500 to cash account rupees 500. Now let's summarize the entire learning. In a personal account, the receiver's account is debited and the giver's account is credited. In real account, what comes in goes to the debit side, what goes out is the credit side. And finally, in a nominal account, all expenses and losses make up the debit entry and all incomes and gains are the credit entry. Let's look at this example. Mr. X has withdrawn rupees 1000 from the bank. There are two aspects of the transactions. X receives the amount in cash, cash being a real account we debit cash account. Bank being the person who gives the benefit in this transaction, the bank account is credited. In short, the cash account is debited and the bank account is credited. Let's look at few more examples. Company ABC has paid a salary rupees 22 lakh to its employees. Again, there are two aspects of the transactions. Salary, which is an expense, is a nominal account and is debited, while cash account, being a real account, is credited since it is going out. Next, let's understand double entry bookkeeping in accounts. Double entry is a system of bookkeeping so named because every entry to an account requires a corresponding opposite entry to a different account. Let's understand more about this. For example, Mr. X received rupees 100 as income. In this scenario, two journal entries would look like debit rupees 100 into cash account and credit rupees 100 into incomes account. Let's understand the features of double entry accounting system. Double entry is the fundamental concept underlying present day bookkeeping and accounting. Double entry accounting is based on the fact that every financial transaction has equal and opposite effects in at least two different accounts. It is used to satisfy the equation assets is equal to liabilities plus equity, in which each entry is recorded to maintain the relationship. In the double entry system, transactions are recorded in terms of debits and credits. Since a debit is one account will be offset by a credit in another account, the sum of all debits must therefore be exactly equal to sum of all the credits. The double entry system of bookkeeping or accounting makes it easier to prepare accurate financial statements directly from books of accounts and detect errors. Let's look at an example to understand this concept better. Mr. PQR is purchasing drink from a shop. This simple transaction has two effects from the perspective of both the buyer as well as the seller. Here, the effect on the buyer would be that the buyer's cash balance would decrease by the amount of the cost of purchase, while on the other hand, he will acquire a bottle of drink. Conversely, the seller will be the one drink short, but his cash balance would increase by the price of the drink.